All right. Good afternoon, Checkmate Trading Crew. Today is Tuesday, August 30th, 2022. It is just after New York City here here on a beautiful day. Let us begin. Okay, so this is our first high noon highlights of the week. We have it Tuesday, Wednesday, Thursdays. This is the first one after Jerome Powell spoke on Friday. Before we begin, actually, today the high noon highlights is going to be structured a little bit differently. Rather than doing all of our indicators and all of our trade plans at the very end, I am going to split up the episodes into different chapters based on different asset classes. For example, in the beginning, we'll go over equities, then we'll go over commodities, and then we'll go over crypto. But in those chapters, I will put my plan on those asset classes for those, so basically instead of doing it all at the end, I'll pepper it in based on what we're talking about. So if you want to see my plans for, let's say, oil trade, just go to the commodities section where I talk about oil, and that's where I'll go over my plan for oil in that section. Okay, just wanted to make that clear. So again, this is the first high noon highlights since Friday, since Jerome Powell spoke. He spoke for about 8 minutes on Friday at the Jackson Hole Summit. He mentioned inflation multiple times. He even mentioned Volcker and spoke about the likely pain ahead. And those are his words, not mine. Okay. The Fed funds futures market, however, is pricing in 4% Fed funds rate before the end of the year, with that being maintained for the first half of 2023. So this is the Fed funds rate right here. All right. As you can see, in December, we're pricing in 4. Okay. So it looks like the market is now increasingly pricing in 75 basis points for this coming September meeting. After the 75 basis point rate hike, another 50 basis points in November, and another 25 basis points in December. And we keep that 4 all the way through to July. Okay, so far, that's what's being priced in. Okay, I talked about this back in May, that William Dudley, who is the ex-president of the New York Federal Reserve, he actually came out with an opinion piece back in May that said that we may need a 5% Fed funds rate to really stomp this inflation out. So I think, my opinion is that the Federal Reserve is using Bill Dudley as their de facto mouthpiece, and they're testing out messaging through him. And so if he says 5%, I'm pretty sure that's what Powell is thinking. Whether or not the market and the bond market acknowledges that or not remains to be seen. So we shall see. Next, we talked about this in the high noon highlights and last week's Theta Thunder. We had some extreme positioning in the S&P 500 cash index, that's SPX. We had some extreme positioning in their options market. And as I said then, we may get some large moves. And lo and behold, that's what happened. We got some large moves. This is the options chain here. I didn't save my settings. I wanted to show you just the monthlies. But if you look at the monthlies right now, I mean, it's pretty much, this is a huge options expiration. If we actually go to the September chain, you can see, remember I told you guys we had some big put walls, 4,200, 4,150, 4,100, 4,000. That is that mega options expiration right here. So as I said then, we cut below some of those key put walls on the September options chain, again 4150 and 4100. And when we saw those, when we saw the VIX also make a large move, we saw commercial dealers and market makers scrambling to cover those short puts. That's why last week I said don't be surprised if weakness begets more weakness. All right, as those short puts increase in delta because of the gamma effect, these commercial dealers may have to cover at whatever price. So they're just buying up those puts at whatever price. We saw the VIX spike because of that. We could see the markets rallying if we see the VIX fall, and dealers then will need to scramble yet again to hedge their shrinking negative delta in their inventory. So if you see that VIX really make a downward move, I think it's a very good chance that we could visit those higher levels again, 4,100 to 4,200. Right now, it does appear like as if we're settling around that 4,000 strike, that huge strike we have for both calls and puts right here at the 4,000 strike. All right. Now, this does not mean it has to happen. All right. Nothing is stopping volatility from continuing if it wants to return. And if we lose that 4,000 level on SPX to the downside with VIX spiking, and if we break VIX 30 on the upside before the end of the September options expiration, we could see market makers and commercial dealers having to scramble yet again to cover those short 4,000 puts on that September OPEX chain. Also on the VIX calls chain on strike 30 as well. Huge, massive OI open interest there as well too. So let me show you that as well for the VIX. On the VIX contract here on the 21st, we have here the 30s, huge OI right here in the 30s, right there, 148,000 contracts. All right. So that is, they could go ahead and cover that. And that also, again, weakness will beget more weakness if we lose that 4,000. Okay. So keep that in mind. This was a monster and historic monthly options expiration, not just for SPX, but also for VIX. Now, there is a possibility of a gamma pin at 4,000. All right. We have a gamma pin video in our education playlist on YouTube. I will post a link of that in the description section of this video. But just in case, as a reminder, when commercial dealers are long a call, let's say the 4,000 strike calls, and prices start moving above that 4,000, those calls increase in delta. So the dealer will have to short more of the underlying to have a matching negative delta to neutralize the increased positive delta from the call that is more in the money. So this causes prices to fall back to our strike. In the opposite scenario, when commercial dealers are long a put, again, we will use our 4,000 strike example, the prices start moving down below and when prices start moving below that 4,000, the deltas on those puts turn increasingly negative. So the dealer has to go long on more of the underlying to match a positive, to have a matching positive delta that neutralizes the more negative delta from the put that is getting more in the money. So this causes prices to rise back to our strike. Now, generally, a multi-session gamma pin, so a gamma pin that lasts for like 2 or 3 days, it usually happens about a week or a week and a half before the monthly options expiration, which happens on the 3rd Friday of the month. If the pinning around a large monthly open interest happens this early, usually the market will break one way or another within about a week or two, which happens to be after the Labor Day holiday here in the US, right as we often see volumes returning back into the markets as institutional traders come back to man their desks. So it definitely falls in with seasonal patterns as well. All right. Now, what could set off this volatility? Any number of things. Right now, if you look at the TNX, which is the 10-year Treasury yield, all right, right now, It's getting over that 3.1. All right. If TNX, if the 10-year Treasury rate, busts out, I can definitely see that being headwind for risk assets. Now, right now, the S&P 500 is priced at about 17 times forward earnings, which is just under the 10-year average. All right. So if interest rates have to go up, then most likely, the S&P 500 and a lot of risk assets are going to be priced at lower multiples. All right. So that gets rid of some of the institutional bids and actually will lower the institutional bid if we see a dramatic increase in the 10-year Treasury yield. All right. So right now, the expectation from the bond market is that we have a 4% Fed funds rate. If it gets to 5, definitely TNX will go up, and we could see volatility come back as well too. Okay, we could see volatility increase because of that. All right. Now, another thing that we can look at is the MOVE index. The MOVE index is the bond market volatility, and if we actually compare it, all right, this is something that I played around with over the last few days. If you actually compare this to the VIX, all right, it's been actually quite what is it? It's actually been quite correlated with the VIX, the volatility in the bond market. And if you actually look at it on a percentage basis, all right, on a percentage basis, since around May or so, it has underperformed just slightly. As you can see here, it's tracked it actually very well. The VIX and the MOVE index have been tracking very well on a percentage basis. But recently, VIX has underperformed the volatility in the bond market. Will it catch up? It's definitely a possibility. All right. And that, I could see, quantitative algorithms definitely bringing the VIX up to match the percentage increase with MOVE. Okay. It looks pretty compelling, does it not? All right. So my plan in equity still hasn't changed. I'm still going to long SPY at our levels. All right. I'm still looking to add some shares at 360. Most of my buying will happen in the 340, 345 zone, or if we get the MOAB signal. The MOAB signal is the mother of all buy the dips, okay? The mother of all buy the dips. And that will happen if we see the New York high-low line curl up, as well as all the moving averages curling up. We have not seen that yet, okay? We have not seen that yet, all right? Also, too, with our junk bonds AD line, we made a lower high. It's possible that we make a higher low. Okay, if we make a higher low, that would initiate the mother of all buy the dips. It would initiate the MOAB. It would not complete it, however, and we will only act on a completed signal. Okay, so we're nowhere close to that yet. All right. So if we do get the MOAB signal, I will also go long on some Russell 2000 or SPY 1 year or more leaps calls as well too. All right. Remember our risk off spreads that we have, all those put spreads. I'll just run through them right here. We have our DIA spread. For October, we already know what the positions are. It's the same positions as always, 300 to 290. We've got our EWT for December, which is the TAIWAN ETF, 4940 put verticals. We have FEZ. Most of our FEZ is naked puts long. I still have a couple of spreads just because I couldn't get rid of all of these 27 puts. These 27 puts were closed out at about 25 for most of my position, but I do have a few still spreads at 32.27. Most of my 32 puts, however, are naked long. All right, that's FEZ, and also IWM. Still the same 180, 170 put calls for both October and November. All right. And then also QQQ. All these, well, as a combined position, all these puts combined, I do have a pretty good profit on them already. 305, 295 on the QQQ. So I've got some pretty good profits already baked in. Also UVXY as well. Part of this position was already paid for. I believe part of the UVXY and all of the FEZ and DIA puts were paid for by the Baidu calls that we did about a month or so ago. All right. So I'm still in those positions. We're seeing VIX drop down a little bit and SPY popping. Look at that. So again, one of our scenarios playing out. But anyway, I still have those positions. I am going to start managing those positions when we get to the lower Bollinger Band on the indices. So right now, if you look at the triple Q, for example, on the weekly chart, the lower 2 standard deviation Bollinger Band is right around 273 to 275 or so. That's where I want to take profits on my spreads. So I do think we still have some volatility ahead, and I think we might see that, especially if the liquidity data deteriorates any further. However, if I do see that liquidity conditions are improving, I will take the small profit that I do have and I'll walk away. Okay? So either we get to that level or we see liquidity conditions improving through our New York high-low line, New York Stock Exchange high-low line, as well as our junk bonds AD line. Okay? So we'll base it off of that. My plan for the other individual stocks, HUT, for example, I'm still going to buy at 165. And I'm still waiting for a Ford to get to about 1380 or so I can buy some shares. So that's my plan on the equity markets. All right. Other risks that I'm seeing, this is more of a medium-term risk, and we've talked about this even in June and July, but there seems to be more problems now brewing in emerging markets. Back in the end of June, early July, we talked about Sri Lanka and issues that they were having. Their former president fled the country after demonstrations turned violent after there was fuel rationing and a huge rise in cost, especially in food. We mentioned back then as well that we could see this problem spread to other countries, particularly other emerging market countries, as the dollar goes up. And we've seen the dollar going up for the past few sessions. King dollar is definitely back. Now, if this continues, I would suspect that this would be headwinds for risk assets. Now, remember when I said then most debt is denominated in dollars and most trade in commodities is also denominated in US dollars. And so when the dollar goes up, the cost of servicing that debt and buying those commodities increases. This hurts emerging market countries the hardest, and we are starting to see this happening in Argentina, Egypt, and now the most recent Bangladesh. Okay, the Bangladesh minister had to make an announcement to settle fears about food stocks and the possibility of food shortages. Recently, Bangladesh, which is the 4th largest rice producer in the world, had to secure rice shipments from India, who's the 2nd largest rice producer, and Indonesia, who's the 3rd largest rice producer, as their domestic rice crop appears to have a lower expected yield at harvest. Now, this problem is not only in Bangladesh, but also in India and other rice growing nations as well. It's the weather. The whole area, Pakistan, Bangladesh, India, they all had a very stormy monsoon season. And on the flip side, China, the largest producer of rice in the world, had record drought, which most likely will affect their rice yield as well. Now, to grow rice, you need flooded fields. However, not so flooded where there's torrential water flow like what happened in Bangladesh and in India during this monsoon season. So more than a third of the world uses rice as their staple. Okay, what's going to happen if we get too low of a yield? And if you actually look at prices of rice right now, Let's see here. There's actually a pretty good chart on trading economics on rice. Okay, and as we can see, rice has been on an uptrend. Rice has been on an uptrend like this. All right. And especially if we're seeing lower yields, that could go up. So what happens then to world inflation? So if world inflation goes up, then we could see a lot more hawkishness from world central banks. All right. Now, in other commodity news and other grains and food products, there are reports that wheat is making its way out of Russia and Ukraine. Also, on this side of the globe, we have Canada that came out on Monday with a larger than expected wheat crop as well, about 55% increase from last year. However, last year was a severe drought year for them, so it was a low hurdle to pass. But we do have a larger than expected wheat crop that is causing wheat to fall a bit after yesterday's news. The strongest of the grains right now is corn, okay? Now, I have already switched my charts over to the December contract of corn, and the reason is the same as why we switched over to the December contract in oil, okay? It's because most of the options open interest right now is centered around that December contract, okay? It says November, but again, it's for December delivery, so it expires in November. So all of these are December contracts that expire in November, okay? There are reports from the USDA, that's the U.S. Department of Agriculture, that their forecast for corn crops that they did a few weeks ago may have been too high. There is an expectation that the corn crop will come in lower than expected at harvest. Also out of Ukraine, there are reports that there will be less corn planted for the next season, and more soy and sunflower will be planted instead. Now, corn is a major driver of food inflation. A third of it is used for cattle, hog, and poultry feed, so rising corn means rising meat costs. Just over a third of the corn is used to make ethanol, and the rest is used for human food and consumption. Corn is found in all types of human foods, cereals, tortillas, beverages, many packaged foods, etc. So, we could see a rapid rise in corn prices lead to higher expectations in inflation, i.e. a higher TIP-TLT, okay? We could see a higher TIP-TLT because of that, although TIP-TLT it's still maintaining its breakout levels, but it is coming back down, okay? However, if we have just a unexpectedly low a corn crop, I can see this going up. Okay, I can definitely see this going up. All right. So again, I'm moving over to looking at when I'm looking at corn, I'm looking at the December contract. All right, because we follow where the money goes. All right. Now, as far as the next corn trade that I have ready, ideally it would have been nice if we could go long on corn, but it doesn't look like we're going to get lower prices here. It looks like corn is running away to the upside, and if that's the case, I'm going to be ready to short corn. Okay. Right now we have the two biggest options, open interest options for corn for the December contract is call walls right here at we have 720, I believe, was the last one. Where's my open interest? Am I in the wrong contract? Oops. Yes, I am. December 2022. Okay. So we have the 720 right here that has 767,000. That's a huge call wall, as well as at 720 and 750. All right. So 700, 720, 750. Those are the big call walls. If you want to be an aggressive trader, you can start scaling in into puts on corn at around, let's say, 720 or so. All right. That would be a good entry. The patient trader would wait for 750 on the December corn contract. And that is where I'm going to place my trades. I'm going to buy put spreads on either corn futures, or I'm going to use the corn ETF, CORN, and buy put spreads that are about 2 or 3 months out when we get to about 750 or so. So again, not the front month contract. I'm looking at the December corn contract. So on TradingView, that would be ZCZ 2022. Okay, ZCZ 2022. All right, when that gets to 750, I will short corn. All right, that's part of my corn plan. All right. So with increased feed costs, there comes increased meat costs. So we see that feeder cattle is still on its upward price trajectory. It's still near its highs. When beef prices go up on the shelves, usually the American consumer starts eating more pork and chicken, and those meat prices will start increasing as well too. And usually that leads to higher margins for the wholesaler slaughterhouses. And so that's why we still have a plan to go long PPC, which is Pilgrim's Pride Corporation, which is one of the larger chicken slaughterhouses. We still have a plan to buy this at the 2 standard deviation Bollinger Band. Oh, it's right there. Oh, barely. It's almost there. Okay, it's almost there. So, you know, the patient trader can also wait for the MOAB signal. So I don't know if I'm going to buy right here with all this selling going on in the market. I may just wait for the MOAB signal, the mother of all buy the dips, and then buy this. Okay, but the aggressive trader can start buying here. Okay, I don't think it's a bad thing to start legging in now if you're aggressive. Me, I'm going to be a little bit patient. I might just wait for the MOAB signal to buy into this. But this is definitely a stock that I want to be in. Okay, I do think meat prices are still going to go up, and chicken prices especially, since feeder cattle and other protein prices are going up as well. All right, speaking of oil and commodities, you know, right now, oil, we're looking at the ZCZ. It looks like we're about to hit, oh my goodness, it hit our 18-day moving average. So I said we were going to go long here. I'm going to, we have to confirm that this is going to be, I think it just hit. Yeah, my alert just went off right now, just like just a couple minutes ago. So we might see this as the bottom. If I see prices retreat from here and confirm that this is bottoming, I will buy some call spreads on USO. Because there is a little bit of backwardation on the crude oil contracts. That's tailwind for USO and for those futures rolling strategy ETFs. So I will buy some call spreads that are, you know, about, you know, 30 to 60 days out, and wait for prices to reach about 100 or so on the December contract of crude. After 100, that's where I'm going to take profits, and then I'm going to short oil between the 105-110 zone on the December crude contract. Okay, so that's my plan so far. But I do need to see this bottoming, but that is very compelling. We're right there at that level. So if it starts retreating a little bit, maybe get a 1-hour candle confirmation above this zone right here, then I'll go in. Okay, I think my alert literally triggered like 4 minutes ago, it says. Okay, so we'll see. We'll see what happens. Okay, I'll post on Discord if I take that trade. All right. Most likely I will. I just want a 1-hour confirmation, just with all the volatility going on. I just want a 1-hour confirmation that it's going to hold. All right. In other energy news, the price of natural gas in Europe fell about 20% today after news came out in Germany about its gas storage facilities being 85% full by next month, which is earlier than their October target. So a lot of this buying in natural gas in Europe was buying at whatever price. And the chatter amongst professional energy traders is that there is anticipation that the whatever price bid will no longer be there after September. We shall see, okay? We'll see about that. But I think there's a lot of interesting moves going on in the natural gas space. In metals, all right, I still have my plan to buy gold with a small call debit spread. Once it gets to that 1680 zone, we will see if that holds. But 1680 is what I'm looking for in gold. Let me see where I can find our gold chart. Right here. Okay. So 1680 is right here. If we get there, I go long with a small debit call spread. Okay. That has not changed. Now, if you're going to be in one metal, okay, if you're going to choose one metal to play, I think it should be uranium, all right? With higher fuel costs, my thesis is that governments are going to get friendlier to the idea of using nuclear power plants. And the U.S. has already committed to adding to their uranium inventories, and Japan recently announced that they will look to expand their nuclear power capabilities. I still have my plan, all right, to buy UUUU, all right? I really want, ideally, I want low sixes, high fives, but I may start scaling in around mid sixes, 650, 660 or so. All right. But I would like a pullback to buy. I may also buy some leaps on DNN. DNN is another uranium miner. It's a very low dollar stock miner. I may buy some leaps. Off the money, low delta leaps that are about a year and a half out, just as a lottery, okay, just to supplement my shares that I have of UUUU that I want to buy, all right? My time horizon on that is about 3 to 5 years at least. So when I buy that, I'll hold it for 3 to 5 years, and most likely, if I buy that, I'll feature that in Theta Thunder as well, because we will be selling premium around that position if we acquire that position, okay? In cryptos, some interesting developments, actually. It's not about what happens. It's about what didn't happen, okay? We saw a lot of open interest fall off on the Ethereum options chain, okay? Remember how the Ethereum options chain had a notional open interest value of about 7.9 billion last week. Now it's at 6.6 billion. Okay, and this number hasn't been going up. Okay, it's been kind of here for a while now, for the last 2 or 3 days. Of course, we had the weekend, and the weekends it doesn't change as much. But I would have expected some of that open interest to come back. But it looks like a lot of people sold their calls, which is pretty understandable, as retail has been chasing calls on this for a while, especially short-dated calls, and I think a lot of retail got wiped out on that huge drawdown that Ethereum had. It went from 1900s down to the 1500s. A lot of those short-dated calls just became worthless, and a lot of people closed them out. There's only about 6.6 billion notional value left. All right. I still have my plan to buy Ethereum and Bitcoin when it gets to our crypto to gold ratio. Our ETH to gold, for example, once it gets to that red line, I will buy. I'm also willing to buy if we get our MOAB signal like we talked about. Okay, if we get the MOAB signal that I mentioned earlier, I'll also nibble at some Ethereum longs as well too. All right. So that's that. There's still there's some negative delta exposure for September, but if you look at December and March 2023, there's still a lot of positive delta. So a lot of the big money or the people that went in, those multi-million-dollar trades that we looked at over the course of a couple of weeks on High Noon Highlights, those are still there. Okay. Those December and March spreads that that 10,000 ETH guy that opened, it's still there. Okay, if you look at the delta exposure, we still have it here. But negative delta for September. Maybe some put chasing over here, but definitely the calls are still open. Okay. So that's that. Today, we went over, all the things that we usually go over. Again, I separated them into different asset classes and different chapters. It's not all at once. My whole plan, indicators, everything is not all at once at the end. So, in our commodity section, that's where I put my plans on commodities. On the stock section, that's where I put my plans on risk management on our put spreads, as well as when to enter in buying SPY shares. So it's all it's all split into chapters, so that if you don't trade commodities, you can just listen to the SPY and index sections. If you don't trade U.S. stocks, but you're interested in crypto or you're interested in commodities, you can just listen to those. Okay, so there's no need to listen to multiple sections if you are only listening in because of one or two topics. So I just try to make it easier for those people who are more focused on their asset classes. Any questions, comments, rude remarks? Anything else you guys want to go over?
Now gone back in order.
Oh, okay. So for those of you who couldn't hear, our crypto expert, our in-house crypto expert, msc-code, has told us that last night he saw some divergences in small caps and Ethereum. If you remember from last week on High Noon Highlights, he talked about his day trading strategy where he lines up Ethereum and RTY small caps, and he looks for movements in RTY and for Ethereum to follow, because generally they do follow one another. And you're saying now it's back on par.
It's not back on par. It's actually a little off still.
It's still a little bit off. Okay. And which way would ETH have to go in order to, Matt? We would have to go down some more?
Well, it has spent most of today correcting back to that, because I measure RTY as a liquidity measure.
Mm-hmm.
But I would say yesterday, hold on, I'm looking on the chart right now. Around close, started going up when, so around 4 o'clock yesterday. You'll see that green, ETH shot straight up while the futures market closed for the hour that it's closed.
What's the time frame that you're looking at? Are you looking at the 15 minute?
On the 15 minute, yep.
On the 15 minute, okay. Let me go to that.
Yeah, this really works better on the 15 minute, unless you're looking for a long-term trend.
Right.
But the problem is
for day trading, right?
Yeah.
Yeah.
Okay. All the intraday noise, which is really all it is, it's lost on the daily chart. And it would be hard to find an edge there. Let's see. I just switched to daily to see if I could find one.
Yeah, ETH, and then you compare it to RTY. And you look at it on a 15-minute basis. And then this needs to,
Yeah. That is, yeah, there you go. Why is it so flat on yours?
Yeah,
there you go.
Okay. So, I see what you're talking about, the divergence.
Yeah.
Yeah. I see. Oh, wow. That kind of looks like it was a long trade yesterday.
Right.
Yesterday was a long trade. And this is your short signal right here. This was your short signal, but it went up. Ugh.
Right.
That would have been that. So this is why when you day trade with leverage, you got to use stops and you got to respect your stops, because even though what did you say last time? You said this was like 70 or 80% trade for you. Yeah. So that 20 or 30% can wipe you out. Believe me. I mean, all of us who've been trading for at least like 5 or 10 years knows that small little 10% chance can wipe you out. So again, respect your stops. Okay. No matter how good your data is, there's always that small chance you could be wrong. Always remember that. Okay. But yeah, I can see that there's a clear signal here. Are you looking to day trade short on ETH today?
I am too busy with work. I haven't been taking any positions for like the past 2 weeks. Just IMO is long spot. I I have some long-term hedges that are just out there.
Oh, hey, there's nothing wrong.
But
Hey, in this kind of market, hey, there's nothing wrong with sitting out. There's nothing.
so
There's
when I
nothing
was
wrong.
making money on, day trading, I was taking that money and throwing it into my hedges.
Beautiful, dude. Beautiful, beautiful, beautiful. Making money. That's actually very similar to what we talk about at Theta Thunder too, right? Well, for me, it's selling premium, using that premium to hedge. Same thing. If you have a system that works for you day trading wise, and you have a core position around what you're day trading as well, hey, take some of those day trading profits and put it into some hedges. That's a beautiful way to compound and add to your long-term assets. I'm sure that's what you're doing, right? When you cash out your hedges, You're going to buy some more long-term. Yeah. So there you go. All the pros do that, okay? That's the move of a pro, okay? So pros think long-term like that. Even though they may make money on the short term, really the big thing that they're doing, the big picture is long-term, okay? Always.
In case anyone's wondering about my current strategy, when I think that I'm currently bearish on crypto, I am long the spot, short the derivative.
Long spot, short the derivative. Yeah. Okay. Very good.
And since you can use your ETH as collateral to go short, I would recommend using tight stops for that. But yeah, so you could literally be long the spot and short the derivative.
Wow. I'm going to have to look into that myself then. If you can use the physical as a collateral, a lot of my strategies come from that. I don't like putting up extra buying power as collateral. I'd rather use like a long-term asset to post as collateral.
So you can do that on the GMX platform.
The GMX? Okay, I'll look into that. I know you sent me some links on GMX, and I'll try to share them on the cryptocurrency Discord channel as well too.
Also, remember, you want to pull it up real quick, SNX. It's called synthetics. You can pull up the chart.
Oh, is that a SNX? Oh, yeah.
I actually exited today.
Synthetics. It's on Coinbase, right?
You could use that one.
Yeah.
So I actually exited today. I've been in this since about 250, I'd say. It was a fun ride. There's some stuff going on right now in the protocol that I didn't want to be a part of. So I took my profits. I probably started with a half ETH. I now have a full ETH on that network. So it was a good ride. I made a lot of money in staking and using optimism, but there's some stuff right now that's pretty bearish in SNX. So I just didn't want to have my money tied up in it while it was going on.
All right, there you heard it, guys. Our in-house crypto expert is not long on SNX anymore. Would you say that's all? You're just not long anymore, or are you actually bearish on this?
Ooh, that's tough. A lot of the problems that are presented right now could be fixed. So I would say I'm bearish neutral.
So not long.
I ended up gaining about 100 coins or like 150 coins just from staking it. So I kept that as a dust bag. You never know what's going to happen. But for me, that's all profits. So it's
gotcha.
nothing.
So not long. Okay, not necessarily bearish, but he's not long anymore because of some inherent issues with their protocol. Okay, fair enough. That's fair. All right. So beware, those of you guys who are trading altcoins. Just understand what risks you're taking when you're doing this.
Also, GMX did more fees and paid it out to the people that contributed to the GMX protocol than the entire Binance Smart Chain.
Oh, yeah, I saw you mentioning that the other day. What are the implications of that?
Oh, I got paid out on that on ETH, and I know if I use Binance, I just lose money.
Oh, wow. So are you saying that it's possible that GMX may take over market share from Binance?
Oh, Binance Smart Chain and Binance are two different things. Binance Smart Chain is just their version of a blockchain similar to ETH. Some of the things are EVM compatible too, but for the most part, you can't run a node on it. It's all validated by friends of CZ who owns Binance. Then there's the Binance centralized exchange, which is separate from that.
Gotcha. Okay.
But it did do more fees than the centralized exchange on that day for derivatives.
Interesting. So it could be that they're expanding. Okay, so I mean that's something to monitor. And if it shakes up the crypto market, that may be something that may help out setting up a trade for some of you guys that are into more the alternative aspect of crypto.
And also, you don't necessarily need GMX to get paid out through the protocol. If you had ETH, you can put it in their GLP pool. That pool is a basket of assets. It is like 30% ETH, 30% Bitcoin, and the rest is like a mix of stables and like Uniswap and some other stuff. You get paid out about, I want to say 70% of the fees. The other 30% goes to GMX stakers, but you don't have to actually be exposed to the GMX token in order to do this. You can actually just deposit stables or ETH into the GLP pool.
Sweet. All right. Any other things? Any other topics you guys want to cover? Anything else you guys want to see? Anything else? Any comments, questions, rude remarks? All right, well, that's it then. That concludes High Noon Highlights. Let me know what you guys think about this new structure that we have for High Noon Highlights. Give me a thumbs up, thumbs down. You like it? You want to go back to the old way? You like this new way? We should keep doing this the new way. Let me know. Give me your feedback. Again, I'll post the link on our description section of our Gamma Pin episode that we had about a few weeks ago. I'll put that in the description link. And also, again, I'll make chapters on our YouTube video so that you all can pick the sections that you want to listen to. Great session, guys. We'll do this again tomorrow at noon Eastern, as we always do. And again, later this week, hopefully, I'll find some time for us to do another episode of Theta Thunder as well. And on the next episode of Theta Thunder, not High Noon Highlights. High Noon Highlights is Tuesday, Wednesday, Thursday at noon. But on Theta Thunder, which is our long-term investing and options premium selling series, I'm going to go over a trade that I have never lost money on since I've done it 2017. Okay, since 2017, I've been doing this premium selling strategy, never lost money on it once. 100% win ratio on that trade, and I will share that with you guys on the next Theta Thunder. Okay, guys, have a wonderful day, and I will see you guys later.